Let me give you a number. It's been sitting in the back of my mind all week. $73. That's roughly where silver is trading right now. And there's a legitimate, research-backed conversation happening in serious institutional corners of this market about whether $90 is achievable before the end of 2026. Not for Reddit, not from a guy with a gold coin avatar, from analysts with research departments and risk models and reputations on the line. So today, we're going to dig into that argument honestly, not to sell you on it and not to dismiss it, but to actually understand whether the foundation beneath it can hold. Because in a market this emotional, this reactive, this headline-driven, the difference between a smart position and an expensive mistake is almost always about how well you understood the structure before you committed. It's Saturday, April 5th. Drop in the comments what city you're watching from. I genuinely read those. And if this channel gives you the kind of clear-eyed analysis that's hard to find in this space, subscribe to JON AG right now on YouTube. It costs you nothing, and it keeps this conversation going. Let's start with the physical market, because that's where the most durable part of the bull case actually lives. The silver market has been running a supply deficit for nearly 6 consecutive years. What that means in plain terms is that the world is consuming more silver than it is producing. And that gap hasn't been closed by some dramatic vault collapse or emergency supply disruption. It's been closing quietly, persistently, through the slow bleed of inventory that nobody makes a viral video about, because it doesn't happen in one day. London vault holdings have continued to trend downward on a month-over-month basis. Not spectacularly, not in a way that creates panic. Just in a direction that, if you're paying attention, tells you that tightness in this market is structural, not sentiment-driven. Structural tightness is important because it doesn't disappear the moment a geopolitical headline reverses. It requires real production increases or real demand destruction to heal. And right now, neither of those things is happening at the scale needed to change the picture. On the demand side, the story has 2 chapters, and they're moving in opposite directions. Industrial demand is expected to see a modest pullback in 2026, while investment demand is projected to rise meaningfully. Now, a skeptic would look at that and say you're replacing hard industrial consumption with financial speculation, and that's a fair critique. But the fuller picture is this. When institutional capital decides to enter a market that's already physically constrained, prices don't adjust politely. They adjust fast and they adjust hard. The combination of tight physical supply and renewed investor appetite isn't a speculative fantasy. It's a setup that has historically produced outsized moves in silver, for better and for worse. Now let's be honest about where silver has been, because context matters. Silver reached extraordinary highs earlier in 2026, driven largely by an energy shock tied to geopolitical conflict in the Middle East. Brent crude pushed toward $105 a barrel. That kind of move in oil doesn't stay contained in the energy market. It spills directly into inflation expectations. And inflation expectations spill directly into precious metals. Silver, which functions simultaneously as a precious metal, an industrial input, and what I describe as a barometer of collective financial anxiety, responded with the kind of vertical move that makes for great screenshots and terrible entry points. Then it collapsed, sharply. In a single session, silver shed more than 4%. That's not a market correcting. That's a market that got ahead of itself and then paid for it with brutal speed. That history matters for one specific reason. People who are now pointing at silver's prior high and saying it already proved it can get there are making a category error. Reaching a price level during a moment of maximum panic is not the same as sustaining a price level through the kind of fundamental conviction that produces a durable trend. The first requires a catalyst. The second requires a structure. And the debate right now is whether that structure is being built quietly beneath the surface, or whether the market is still looking for the next catalyst rather than the next foundation. Which brings us to the Federal Reserve. because if you follow precious metals with any regularity, you know that interest rate expectations are the gravitational field that everything else orbits. The Fed held rates steady at its March meeting. What isn't settled is what happens next, and the disagreement on that question is substantial. The consensus among economists, as of the most recent surveys, points toward no rate cut before September at the earliest. Some major banks have projected 2 cuts this year. The Fed's own official projections have been notably more restrained. When institutions doing serious, rigorous work are producing forecasts that spread that far apart, the market doesn't drift calmly in a single direction. It whipsaws. It reprices the same data multiple times in a week based on which interpretation happens to be winning the narrative battle on any given afternoon. Here's the distinction that too many silver bulls skip over, and it matters. Rates not going higher is not the same as easy money. Those are fundamentally different conditions, and treating them as equivalent has cost traders real money in past cycles. If the Fed simply holds steady, no cuts, no hikes, and if oil keeps inflation elevated, and if the dollar catches periodic safe haven bids during global uncertainty, silver doesn't automatically benefit from any of that. What it does is spend weeks or months grinding sideways in a range that frustrates the bulls without giving the bears a clean victory either. That kind of market is one of silver's most underappreciated features, or, more accurately, one of its most underappreciated traps. There's also a genuine tension inside the geopolitical argument that deserves more attention than it usually gets. The scenario the silver bulls are most excited about goes something like this. Middle East tensions de-escalate, oil falls, inflation fears cool, rate cut expectations return to the table, and silver rallies on the back of that shift in monetary outlook. That logic holds together on its surface. But here's what also happens when tensions de-escalate. The fear premium in the market evaporates. Institutional money that was holding gold and silver as insurance against geopolitical chaos starts moving back toward risk assets. So the exact event that brings rate cuts back into the conversation is also the event that removes one of the primary reasons professional money has been sitting in precious metals. Which force wins, the rate tailwind or the safe haven headwind? Nobody can tell you with real confidence. We saw this play out in compressed form just this past week. One session, de-escalation hopes lifted silver because the market focused on rate implications. The next session, aggressive geopolitical rhetoric sent oil higher and hit silver because the inflation channel dominated. Same conflict. Completely opposite pricing response. 2 days apart. That is not a market that knows what it believes. That's a market that's still figuring out its own identity. I want to spend a moment on the professional forecast landscape because the range of credible institutional projections for silver this year is genuinely striking. One camp of serious analysts sees silver averaging in the high 70s for 2026. Another equally credentialed camp considers a range from the mid-60s to the mid-70s to be more realistic. That's not a minor disagreement between optimists and pessimists. That's a fundamental difference in how sophisticated institutions are reading the same data. And when that kind of gap exists in professional opinion, what it tells you is that the market hasn't decided what story it's pricing. Is it a scarcity story? A macro story? An industrial growth story? A fear trade? At different moments, it's been all of these things simultaneously. A market that can't settle on what it's pricing is a market that produces violent, uncomfortable, unpredictable moves in both directions. That's not a reason to stay away from silver, but it is a very strong reason to approach any high-confidence directional call with more skepticism than enthusiasm. And if you haven't already subscribed to JON AG on YouTube, do it now, not as a favor to me. Because of analytical discipline, patient, evidence-based, resistant to the hype cycle, is the kind of thinking you want in your corner as this market moves through one of its most consequential stretches in years. Then you want this channel in your feed before the next big move, not after it. So what would a genuine, durable move toward $90 actually look like? I want to be specific about this, because the difference between a sustainable rally and a spectacular overshoot is the difference between an opportunity and a very expensive lesson. A durable move toward $90 doesn't announce itself with a vertical line on a chart. It doesn't generate breathless breaking news alerts. It's almost boring from the outside. It looks like silver absorbing bad news without collapsing. It looks like dip buyers consistently showing up with conviction, real physical demand, not just leveraged momentum. It looks like gold establishing firm, consistent leadership, while silver follows with a lag that gradually tightens. It looks like London Vault data continuing its quiet, persistent decline without any single dramatic event to point to. It looks like weeks of sideways action that frustrate everyone equally, followed by a move that seems sudden only because people stopped paying close attention during the slow part. That's what a real foundation feels like when it's being built. It feels tedious. It feels like nothing is happening. And then it happens. Here's something that shouldn't get lost in all of this noise. 12 months ago, silver was trading around $34 an ounce. Today, it's around $73. That's more than a 100% gain in a single year. From silver, a metal that spent years being written off as a frustrating underperformer that perpetually promised more than it delivered. That kind of move over that kind of time frame doesn't happen when nothing fundamental has changed. The deficit story is real. The institutional attention is real. The investment demand shift is real. Those things create a different baseline for what's achievable than existed in prior cycles. But, and this is the part that separates disciplined investors from expensive cautionary tales, what's possible and what's probable are two entirely different things. And what's probable and what's guaranteed are separated by a canyon that has swallowed more confident predictions than I can count. $90 silver by year-end is possible. I'll say that without qualification. The physical market supports it. The demand trajectory supports it. The macro backdrop, if it cooperates, supports it. But $90 is not inevitable. It is not owed. Oil could stay elevated, keeping inflation too hot for the Fed to act. The dollar could catch a sustained bid on global growth fears. A liquidity event, the kind that periodically ripples through financial markets without warning, could force silver selling among investors who remain constructive long-term but need to raise cash short-term. Industrial demand could soften further if manufacturing data out of China and Europe keeps disappointing. And silver could simply do what silver always does when momentum gets too extended: turn without warning and punish everyone who overstayed their welcome. Could silver revisit the low $60 or even the high 50s before it resumes a higher trend? Yes. Would it likely stay there for long, given the structural backdrop? Probably not. But probably is doing a lot of heavy lifting in a market this reactive and this emotionally driven. Being right about the destination and being right about the path are two entirely different achievements. You can have a completely accurate long-term thesis and still lose money if the road between here and there punishes you before you arrive. In silver, the road has always been violent. That's not a warning to stay out, it's a warning to stay calibrated. So here's what I'm watching. Oil above everything else. If Brent crude softens meaningfully from $105, the entire macro equation shifts. I'm watching whether gold can reestablish consistent upward leadership, because silver without a gold tailwind is a car with a flat tire trying to climb a steep hill. I'm watching London Vault data for the quiet directional signal, not a single dramatic month. I'm watching Fed communication for any shift in language that acknowledges growth softening faster than inflation is settling. And I'm watching silver's behavior on bad news days. Because a market that starts refusing to break when bad news hits is a market that's found something real underneath it. That behavioral signal, more than any chart level or any analyst price target, is what tells you a structural shift is actually happening. Silver deserves your attention. It deserves your discipline. It deserves your patience. It does not deserve your blind confidence, and it absolutely cannot afford your complacency. Whether $90 shows up on schedule, arrives after one more painful shakeout, or takes longer than anyone in this market is willing to admit, the investors who come out ahead will be the ones who understood from the start exactly what kind of market they were dealing with. Tight, emotional, macro-sensitive, structurally supported, and genuinely dangerous in the short run. That is silver. That has always been silver. And the ones who can hold that full picture in their heads without flinching are the ones who tend to be standing when the bigger moves finally arrive. Do you think silver is quietly laying the groundwork for a durable run toward 90? Or does this market need one more meaningful reset before the real trend begins? Be specific in the comments. Tell me your reasoning. Tell me what you're watching. Tell me where you think the story holds and where you think it breaks. This comment section is one of the most serious precious metals conversations on YouTube, and it stays that way because people like you treat it that way. If this analysis gave you something to think about today, subscribe to JON AG right here on YouTube. No paid tiers, no exclusive groups, no separate apps. Just this channel, just this work, just this conversation.